Well, good evening and welcome to this live stream event on the 9th of February 2021. Martin North from Digital Finance Analytics here. Great to have you on board. And we're going to have a very interesting conversation tonight with Chris Bates of mortgage broker fame. In fact, he came near the top in terms of best of breed. So we'll get a bit of information about Chris in a moment on that very point. Before we do that, let me just underscore again, we don't offer financial advice on this channel. We don't know anything about your individual circumstances, so don't take it as that. This is just general conversation. Also, please do play nice in the chat room. No racial slurs, please. We do moderate the stream. This is as of the 9th of February 2021 if you're watching in replay. And if you want to ask a question, do put @WalkTheWorld in your question so that it makes sure you get my attention. There's always a lot of stuff going on in the chat. I encourage that, but I don't necessarily follow everything in the chat. I also have enabled Super Chat, which means that first you can, if you want, pay for your question to come to the top of the list, and I'll try and answer it as soon as we can. And also, if you'd like to make a contribution to help us with our shows, greatly received, because we don't make a profit out of all of this. All goes back into developing more content and building out the studio. So without further ado, let's get rid of that. And I'm going to bring Chris Bates in. Chris, are you there?
Martin, good to see you. Always good to chat.
Hello, great. And nice to see you there. And the audio is, I think, pretty good as well. So, well, now I think we should start with this ninth out of a long number. Congratulations.
Yeah, I mean, 2020 was a good year for the business. And as a team, we grew quite substantially. We did over $130 million of loans, which, every year mortgage brokers go on a bit of a list. And we came ninth, which was pretty stunning as an effort. But yeah, I mean, ultimately, it's the clients on the back of that. We helped over 100 clients, purchase their first home, upgrade, renovate. So yeah, it's been a big year for the team.
Well, congratulations. And, particularly, well, not an easy year, right? With everything that went on, what with COVID and then prices going up, prices going down, prices going sideways, all of those things. But look, we're in a very interesting and some would say new world now. So I think we've got so many things to talk about. What I would like to do, I think, is just firstly get a little bit of a read from you on what's happening, how buoyant is the market, what types of property are moving, what's it doing to prices, and obviously you're going to talk specifically about the Sydney market and specific areas within Sydney actually as well. But it will be a good place to start, and then we can feed in some of the questions. I've got a bunch of questions from earlier on pre-show, but also some coming through as well on the chat. So, but anyway, let's start with that. So what's your read on the market at the moment?
So, I mean, it doesn't take a rocket scientist to sort of figure out that there's been a massive jump in demand and people looking to purchase a home, right? And what's driving that? A lot of the time it's, this real sort of family need, really. There is a lot of people getting older and hitting that family stage or thinking they're going to hit that in the future and, getting ready for that, I guess. But really what's driving it is the confidence is kind of returned, and with low interest rates at, 2%, and also this bit of a positive feedback loop. I guess we've got through the initial sort of waves of COVID. There's no real fear of, this what it was like at the early, last year. And so a lot of buyers are coming to us. We saw it from about May last year. So this isn't new to us. It's really getting out in the media now because the last 6 months, or at least the last quarter's figures are coming out and showing quite substantial sort of growth in some areas. And so, a lot of people are now acting, especially over the Christmas break, they get ready, they read all these news articles, and there's this bit of a lag. But what we've seen in the last 2 weeks is some pretty crazy activity where people are, getting super excited for properties that aren't great properties, paying massive over the odds for some properties as well. So that's a real sign that FOMO and desperation's in the market in some pockets. And so, yeah, we also saw the move, buyer preferences. A lot of people said, people aren't really going to continue to do it. But we haven't seen really any change. A lot of clients are still going to sort of the Central Coast, north of Wollongong, and you're looking at other places outside Sydney, which is completely different to what they would have done at the start of 2020 prior to COVID. So I do think that sort of regional has got a lot of legs to go, especially the premium end of the regional markets. when you compare that to, say, premium ends of, say, Sydney, it's good value and people can still do that and do their job. So, but we're also seeing that once those start to go up, people say, well, hang on a sec, do I really want to make that lifestyle change if I can't find a property that's that much more affordable than in Sydney? And so you'll start getting people back in the city as well. So, ultimately, there's very, very low listings. It's, and it's always lower listings at this time of year, but CoreLogic released some stats last week, and you can just show the total listings around the whole country. This isn't just Sydney, but everywhere. In Sydney, it's very similar to what it was last year. But I think if you took the units out of that and the high density sort of dwellings, and you looked at just houses in good streets, it's almost like a handful available. Hence why you've got all the buyers wanting the very few properties on the market.
Yeah, very interesting. And let's just talk about units versus houses, Chris, because I think there's a significant difference between those two things, right? It seems to me that standalone houses are definitely in demand, but I'm still seeing lots of cracks, if you can pardon the pun, relating to high rise, with a lot of people who'd bought off the plan some time ago still struggling to shift them.
Yeah.
Prices still dropping, valuations also dropping, particularly on the high rise in the suburban area. I was looking at some North Ryde stuff earlier on.
Yeah.
So it really is a tale of multiple markets. As we always say, it's micro markets, isn't it?
Yeah, I mean, I've been on this show for like 2 years now, Martin. I think we just had a chat about it before, and I was warning about apartments back then. You can go and watch it, and the writing was always on the wall. Building a lot, targeted heavily at investors. If you don't keep the investors coming, then you had the building issues. And then you also had lots of 1 and 2 bedders that aren't really suited to the family dynamic, I guess. COVID's also made people realize the importance of space, especially if they need a home office. So apartments not going to suit that. And people are now, with COVID, also got the ability to the pressure cooker isn't there as much. They say, well, I'm willing to go a bit further to get a bit more for my money. Which before they were like, well, I just want to cut down that commute time. For me, time's the most important thing. I need to get back to my kids, etc. I just want to get in the market. And so I think a lot of people, have been, I guess, educated on the risks of apartment. You've got no migration, you've got no uni students, you've got tenant issues, falling rents. A lot of investors aren't going to go back because they've already been burnt. So you can't encourage more investors. You haven't got first home buyers. Who really wants them? And they've also still plenty getting built. There's still lots of cranes going around. What's interesting, though, is the off-the-plan sector and new developers really like when the market gets hot, because you get all this desperation out there and you get a lot of buyers who just want to get rid of that pain. They don't want to keep looking on weekends. They don't want to keep telling their family they haven't found anything, or their friends. They just want to say they've bought something. And that's when they go into a sales office and get sold an off-the-plan apartment or a new house and land package, etc. So, that's going to be great for that sector and sales. But all the existing stock, you've got to also, wonder what's actually going to turn that around. There's no real demand that's going to really go there, really, and you've still got more supply.
Absolutely, Chris. I think that's exactly right. And there's a lot of people who are still saying to me that they're trying to sell their properties in my surveys, right? And a lot of it is the apartment sector. So they're really struggling to know what to do because the valuations are pretty low. And, when you've got 6 properties all the same in the same high-rise block, there's no way to stand out unless you discount deeply. So it's interesting. Now, here's an interesting one, which I'll just pick up from Dennis. What about job seeker driving the economy and demand for housing? Do you think, the end of JobKeeper and job seeker at the end of March is going to have much of an impact, or do you think it's pretty much faded already? What do you think about that?
This is a little bit like the payment holidays. I think it's a little bit of a storm in the teacup. I think everyone was saying payment holidays are going to end September cliff. They got extended. A lot of them have people have gone back to paying their mortgages, especially where rates are. I think JobKeeper is going to be the same. Yes, businesses are going to go under. Yes, people are going to lose their jobs. But I do think that the demand that's been encouraged because of low rates and home builder and all these sort of things encouraged to push the market up are going to offset any people who are going to sort of leave because of job seeker. So we're just seeing that. We've got people in lots of different industries coming to us. And it's really, they're not on job seeker. They're ready to go. So even if there's less buyers coming to market because of job seeker, I don't think that it's a big issue. So, some people are going to potentially have mortgage problems, but you and I know, Martin, these aren't in every area and every property. They're sort of in groups, really, where there's lots of high LVRs, lots of young couples that have got generally a lot of new property, new housing estates. Yep, you're going to potentially see problems where in those areas, or investors that are potentially over leveraged and they've got poor assets and they've bought cheap properties. Yep, that's where you're going to see problems with property with job seeker. But yep, you may not see as many people coming to the market, but you can already see that, you've still got 98% of people still in, 92% of people still employed rather than, 95. So, yeah.
Okay, very interesting. And here's a one which you might be interested to think about, Chris. This is from Cross Stitch. My broker made so many errors on my docs. What basic standards are there for brokers? I feel stuck. I can't fire him after I sign paperwork. I signed before I knew he was so bad. So basically, if you're in a broker relationship that's not working, what can you do? But more importantly, what standards are there in terms of, just the basics? I know that we've got sort of best interest stuff now, which you didn't have previously. But what's your reaction to that story?
I mean, if they're making errors in your docs, if this is just a pre-approval application, absolutely you can, as you say, fire him and go somewhere else. That's the benefits of a pre-approval. You're not actually obligated. If you signed up to a mortgage and you've got a property at, say, 90%, you haven't got equity to refinance. I guess if you've got a poor asset and you've made complete fraud, then I'd be going to the ombudsman and, explain what's happened. But it's a hard one to say exactly what's going on. The standards wise, the reality is, we're a profession, we've got a license, we've got a business that we're trying to maintain. So when you start getting these issues, you're just throwing your career away if you're that sloppy. So, I can't really say too much about it, but it sounds like it's just common sense to fill things in the right way. Is there sort of big mortgage fraud? I know UBS sort of had a lot of articles on this, and yep, there was a lot of people underquoting their living expenses, hence why there was all this investigation with Westpac and ASIC and, where's the rules around responsible lending, etc. So absolutely, that was a huge problem, and potentially people were overstating income, but a lot of the banks were verifying that anyway. So I don't think there's these big liar loans out there that a lot of those things would have been unwound, I reckon.
Right, but let's talk about professional standards, right? Because there are actually some requirements now and obligations for mortgage brokers to essentially do certain things in certain ways and make sure they keep documentation and all of those things. So there is a bit of a drive, I think, to improve the professional standards in the industry.
Yeah, there is. I guess it's for us, it's just like a ticket to the game. Ultimately, clients are a lot savvier, and so it should be. You just type into Google, what's the best rate? It's pretty quick. You can get up to speed. Whether you qualify for that rate or not, it's a different question. But you can figure out where good pricing is. So if a broker's not really coming to you with the best deal in the market, it doesn't take a rocket scientist to figure out that might not be the right thing for you. Yes, they're improving the standards and they're trying to create more mentoring and best interest duty, etc., which are all great. But really, you shouldn't be a broker if you're not really doing that anyway. So, we're all for any sort of additional legislation and making things harder for us, as long as it protects consumers more. So, it's going in the right direction. But a good broker should be offering you the best products. Before there was a bit of a grey area. They had to produce something that was not unsuitable for you, which is it's just horrible wording, right? Like it should be picking the best thing for you and document that and show a number of options. So we're heading in the right direction.
Okay, very good. Now, the other question I had, which is sort of to do with regulation, is responsible lending, right? So the responsible lending obligations are in the Senate at the moment, probably going to be removed end of March or beginning of April, or maybe a bit later, depending on when it goes through. What's your perspective on that? The pivot away from responsible lending towards essentially financial stability and APRA's supervision rather than ASIC supervision.
Ultimately, banks being banks, they haven't got many tickets to make money, and their biggest sort of way of getting sticky customers so they can sell other products. If you get the mortgage, you can get other things, right? So banks are always wanting to lend money for mortgages and grow their loan book. And if you make it easier for banks to lend more money and they can lend a bigger portion amount of money to each customer, which I think responsible lending will do, ultimately you encourage credit growth, especially at low rates. And so that's what they're trying to do, obviously. Is that going to find people that can get around the system like we saw in 2014? Whereas if you knew what you were doing and you knew how to play all the banks off, and there were some problems with borrowing capacity calculators, you could leverage your income way beyond that was really fair and sustainable for you long term. So I hope we don't go back to sort of 10 or 12 times income, which we saw in 2014. Are we going to see it, rise more than 6 to 7, potentially because of responsible lending? And that's where you're going to start to have problems where people are getting into enormous amount of debt on their current income. And if anything happens to their current income or their partner, or they don't get that bonus, then all of a sudden they've got a lot of debt, and then they might have principal repayments or no tenant, and you start to create these sort of problems. So that's what I think will happen. I do think there's going to be some good product innovation. We might see new products for first home buyers. You might need to see some products for downsizers and reverse mortgages. And hopefully those things, do come because, just to make it fairer, say first home buyers, you don't have to have LMI, just better limits and things like that.
Okay. And Cross-Stitch Ange had a follow-up, which is quite an interesting one. I'm building my house at the moment. Once it's built, if I refinance, will the broker lose commission? Normally, that's true, isn't it? That the trail commission stops if the thing is refinanced.
Yeah, it's 2 years. So you've the first year, the broker would lose 100%, and the second year, they'd lose 50% of their upfront commission. So if you refinance from a broker who set you up a loan the first 2 years, they're either going to get half or no money of what they were going to get paid. And then obviously there's an ongoing sort of trail commission that the brokers make. So absolutely. But after 2 years, it should be fine. The reality is if the broker loses a commission because you have to sell, that's just the reality. That's just part of the business. It's just what happens. I mean, a broker's a bit upset if they've done a great job and then you refinance for potentially a tiny margin saving without going to them first. So they give them another opportunity to see if they can get you a better rate. I think, especially if they've guided you through a big purchase, I think you got to be, respect and value some of the things they would have said to you that you may have got learnings through that process. So you just got to be careful burning bridges with good brokers. But if they're not looking after you, then just swap. It's just the reality.
Absolutely. And there's an interesting comment here from John, I'll put up, which is one of his neighbours got pre-approval for 600k loan. So he's drawing parallels with The Big Short. I must tell you that I've had 3 or 4 people say to me, do you realise I was just given the offer of a 1.3 or $1.2 million loan from the bank, 8 times income, and none of them were comfortable because it was too big, right? So it's feasible to get a bigger loan than actually people feel comfortable about.
So I don't want to start a bit of a war here with the bank branches versus broker, but we are seeing difference where you go through a broker, they're documenting everything, they've got a business on the line, they've got reputation, they've got accreditations with all the banks. They can't afford to, potentially bend the rules, right? You're crazy if you do that. But in the branches, there's certain limits that they can do pre-approvals at without sort of going through credit assessors. They're in a branch, they're going to get moved around into different roles. I do think that's where we're going to potentially start to see problems. We're seeing huge differences in the turnaround times. If you walk directly into a branch versus through a broker, even though there's not meant to be channel conflict. So it is one of these things that are building up in the broker world where the banks are really trying to take on brokers. The reality is what the Royal Commission was the banks trying to kill brokers. Because brokers were getting more market share every year because consumers were getting good service, they were valuing that service, and they're going back to brokers than banks. And that's what the banks are really worried about because it's less profitable. Their margins are already getting squeezed because of low rates and competition. And then they have to give some of that to brokers. So, this channel conflict's becoming quite a big issue within the broker community.
Absolutely. And it's interesting because some of those sort of special rates that you used to be able to get via brokers, I've seen some bank branches now essentially undercut them deliberately.
Absolutely. We're seeing pricing that you would never have got if you're a broker, and even if you know exactly and you're running a lot of business and they're a great customer to the bank, and sometimes they're going into the branch and getting better pricing, which by the rule book, that's not meant to happen. You're not meant to be fighting with brokers because we actually one of the biggest way for them to actually grow their business through new customers is actually through brokers. Why else do you swap your bank account? And so it's a really interesting issue that's growing every year.
Absolutely. And I think it's probably going to be a really interesting battle ahead. In fact, if you look at the mix between branch originated and broker originated, it's still, growing broker's direction rather than branch direction.
Yeah, I think it's around 60% now that goes through brokers.
Yep.
They're always going to own a certain portion of the markets, whether it's that sort of private, wealth sort of side. But we get a lot of those clients that are, earning, say, more than 400 or borrowing more than a few mil. And, they're getting private banking experience. But because there's a product niche somewhere else, or and so they move around more than they used to. They don't just stay at this sort of, and so even the banks are worried about that sort of high net worth customer getting, poached from them as well.
Absolutely. Now, here's an interesting one. What's the average mortgage amount you're seeing on a house purchase of 1.5 mil plus houses, which we sort of touched on, but we are seeing a lot of people with big mortgages, very big mortgages, right?
Yeah.
What sort of multiples are you typically seeing?
Most people are going up to pretty close to their limit, to be honest. The reality is they are going out there and they're in the market and they want to get a home that they want to grow into, and the cost of that is, so a lot of people are going in, 5-6 times their income, and so let's say they want to buy something at 1.5. A lot of them are probably going with 1.3s, no more than generally 90%. Well, we don't do that, but you might find that a lot of them will have 1.2s and 1.3s, especially if they're first home buyers, and they put every single dollar into it. They've maybe got 50 grand from the parents, and so that's the case. The thing that a lot of people probably don't realize is that there's a lot of people that have got other properties that have purchased maybe 5-10 years ago. They've got quite a bit of equity built up, and then when they sell that, they're taking that for a deposit for another house. And so a lot of the people buying at the 2 to say 3 mil are not going in there with 200 grand deposit. They're going in there with half a mil, etc., through other sales of other assets.
Yeah, absolutely. And it's quite interesting how in my surveys I'm watching the proliferation of multiple property owners, right? So, there's people with more than one property interest. Even now, it's definitely going up, which is interesting because if you look at investment property returns, they're not flash. Houses a bit better than units, but if in New South Wales and Victoria the returns aren't flash. If you go up to Queensland, you might get 4, 5, 6% gross returns, where the net returns lower. But we are still seeing that sort of proliferation of multiple properties, and I think we're going to see more of it.
Yeah, we haven't. So the whole 2012 to 15 range is when investors just absolutely swamped the market. You had all this discontent building with first home buyers that were never going to buy a property, etc. And investors were almost buying more than home buyers at one point. Hence why APRA stepped in, and hence why they put interest-only caps and investor caps. We haven't really seen that investor growth. This is being driven by home buyers, and people are trying to buy something to live in, and it's usually in the housing sector rather than the apartment sector. What's interesting though is at some point when you look at the investor rates, investors are always, I only buy when things are going up. People buying Bitcoin now, they're like, oh, I'm missing out, let's buy something. And so I think that's going to be the same with houses and investors. I think you're going to start to really see that in 2021, especially if this next sort of autumn period has quite big growth. A lot of people are saying, oh, should I buy an investment property? We've seen a change definitely in the last 3 months, but there was no investors in the market for probably 3 or 4 years, from late 2016 to probably, late 2020 sort of thing. So, I think the investor growth is very slow to really come into the market. So I'd be surprised if many people are doing that just yet. But I think 2021, that's the problem for the market, because they're new buyers. If you sell a house that you're living in, you've created one supply and you're another buyer in the market. So you're not really net really too much. But if you're an investor, you're not adding any more properties to the market. You're just buying more properties. And that could be a bit of a problem, especially with low supply.
Yeah, very interesting on that one. And Matthew's asked, how does negative interest rates affect mortgage brokers? Well, presumably there's an impact in terms of, pricing of mortgages, whatever that is. But are there things beyond that you might be thinking about if rates go negative?
I think we're a bit away from there, but if you look at the world, and I was in the UK in 2008 when they went to zero, and I still shake my head as I just did then, because they're still zero now, and they're negative all over the world. So Are we in that direction? Probably. What's going to happen? Who knows, right? I know there's countries around the world where you get paid to take out a mortgage. So, is it in Australia? We'll have to wait and see.
Cross-stitch Anne says, "What's in your tea or in your mug? Is it tea?"
Oh, just vodka, but that's okay.
Now, obviously, people. Yeah, I know. I thought it was a joke. Drunk in charge of a live show, eh?
Yeah, exactly.
Interesting question. What happens if rates go up? The chances of rates going up high anytime soon is zero, in my view. I think Phil Lowe said the other day, don't expect anything for 4 years. Rates may go up a little later. Possibly. So what do you say to people, Chris, when they're thinking about how much can I afford, and what extent do you talk to them about the upside, if in fact?
Yeah,
that's okay.
Yeah, good question. So ultimately, I've always been really encouraging clients to think through long term how their life's going to change, how their income's going to change, where they're going to live, etc. And definitely one of the things I always like to talk about is the future with rates. Now, that conversation was really productive when rates were, say, at 4 or 5% and protecting them if they went to, say, 6 or 7. It's hard to have those conversations right now when you've got a variable rate at 2.5 and you've got a 5-year fixed rate at 2%. And I'm saying you need to be worried about rates going up. Okay, so it's hard to start to put people in that. But ultimately, rates going up means probably the economies around the world or inflation. And so, could you protect yourself from it? Yes, but the reality is the market's driving off low rates. So if you be the one that says, I'm going to be conservative because I think rates are going to go up, and you spend less and you don't invest, or you just keep your money in the bank, you're going to get absolutely smashed with keeping money in the bank. And I think you're going to really miss out on the market rising off this sort of momentum on low rates. Now, you might not agree with housing affordability and that housing is a financial instrument and that our Australian economy is built on housing and that you think it's overvalued and it's ridiculous and how can people afford that? The reality is the system is built like that. And so you can either sit on the sidelines and be part of it, but it's just about playing that system better than most people because, not every property investor is happy. In fact, most investors, we had over 500 new clients calls last year. Have I seen many property investors get it right? No. And that's over the last 8 years. Very few. Most stuff it up. They go and buy new apartments or house and land packages or duplexes or Southeast Queensland or, cheap and cheerful regional properties. And so, that's kind of the reality there is that, low rates are probably going to stick around and they are going to drive human behavior. And human behavior will mean that they take on more debt and take on bigger mortgages, which credit growth is definitely one of the key ingredients you need for a rising property market because it's not coming from savings. Like if your property market would go up by $1 million, let's say, that's probably $100,000 of savings, maybe sometimes zero. Most of that's actually credit growth. And so that's what's probably going to drive the market.
Yes, well, I've done modelling of, as you may recall, I think we discussed it on a previous show, where it's the rate of change of credit, which actually is the best correlation of house price growth, right? So in other words, if credit expands, then prices go up, credit expands, banks can lend more, they build their balance sheets bigger, all of those things, and it's sort of this upper circle. The reverse is also true. So if lending is crimped, for example, the Reserve Bank in New Zealand has now announced loan-to-value restrictions coming in because they've got a really hot property market in New Zealand. I did a post earlier today. People are interested in it. That has a downward pressure then on prices. But with
that's
lower...
2018. Yeah. So 2018 was a tightening of credit, reducing of borrowing capacities, looking at living expenses, and also the appetite for credit. Market started falling, right? So if you get this, people want to borrow less, they can borrow less, they don't want to borrow as much, investors pull out, and then people are fearful because they think prices are going to be cheaper in the future. So why would you buy today? And that's what 2018 was all about. And then at some point, people go, you know what? I still think it's a good deal. I can buy this property for 15% under what I could have 2 years ago. And then there was obviously the election, and that's what sort of set it off. The interesting thing you said, Martin, is that a lot of the upgraders need their property to be priced more, so they've got enough equity, so then they can go back to the banks. They're not worried about what they can borrow. They need more equity. When they've got that equity, then they sell their property, and then they go and borrow more money than they've got. And so a rising property market gives people more equity, which means they will sell their property and then they'll go and buy and borrow more money. And so what you do is create these transactions. And that's what this stamp duty change, you might think if you're thinking about buying a property that in 2 or 3 years' time, the stamp duty to land tax is going to be great for you. Unfortunately, that 5% that you're going to save in stamp duty will go directly straight into prices, and actually a lot more than that, because property, what you need is transactions. The more transactions, the more credit growth, and that's what pushes prices up. So if you're very careful getting too excited about the land tax, the stamp duty change, that's a thing that is, if anything, going to drive prices more than low interest rates.
Yeah, I tend to agree with that. And of course, the thing about the switch to land tax from stamp duty is no one's explained to me how they're going to fill the hole, right? Because basically, for a few years, New South Wales, for example, if they switched, would have a massive budget hole while they transitioned.
Yeah, I mean, I'm sure that they're not trying to do it to the top 20%, and they're hoping that the transactions will go from a few hundred thousand, let's say, to 500,000. So they're hoping that, I know they read a report on it this week that they think there's going to be 50% more transactions. So yeah, I mean, that's what they're hoping. The reality is higher prices, higher land. I think they hopefully just want the economy to start booming again with higher house prices, and so yeah, it's not what it seems.
And Cookie Boy just made the point that many investors are toast, especially those who bought relatively recently. 2017 was the peak, I think, of prices. And interestingly, if you look at the investment sector, a lot of prices have come down since then. But more importantly, the rentals have dropped. The rental squeeze is pretty amazing. The fact of the matter is, my data, I'm seeing a lot of issues with people who are just not now being able to get sufficient income coming in to cover the costs of the investment property, let alone servicing costs, maintenance costs, and the other costs. So the net rental rather than the gross rental. And interestingly, of course, everybody quotes the gross rental on investment properties, which is the relationship between the proposed gross income coming in from the rent compared with the price you bought. It doesn't tell you anything about servicing costs and those sorts of things. So
I'd probably go against Sir Cookie. I'll make sure I could add the Sir in there. But, he's saying they're toast because the rents have dropped 25%. Well, rent's fully taxable. So if you've had a 25% drop in rent, you've only had a 10 or 15, let's say a 15 to 20% drop in income, right? Net. The biggest thing that drives investments is their cost of capital, which is their interest rate. Now, when you're talking in 2015, they might be paying a 5% cost to their home loan for the investment rate. That could be under 3% now. So that's a 40, potentially even a 50% drop in their costs, which is their major cost is interest. And the reality is as well, there's negative gearing in Australia. So even if there is a loss, you get 40, 50% of it back in tax. So yeah, as long as you're getting 75% of your income before, and your cost of drops dramatically, the thing where investors are toast is if the capital value falls, and that's the big risk with investing. Yes, you may not have a tenant, but if you get a rent drop, it's not a big deal, especially if interest rates drop. The problem with investing is you're buying an asset, and so what you got to focus on is the asset value and where that goes long term. That's when you become toast, when you get massive falls, or you bought an off-the-plan apartment for 800 and now it's worth 600. That money's gone, especially that money isn't likely to come back because it was driven by investors or just, FOMO in the market.
Hello, Tony. Thank you for your super chat. So Cookie Boy, the Andre Roux of DFA. I'm not sure who Andre Roux is, so I'll have to explain that. That's beyond my pay grade, Tony. Please explain. Thank you for the super chat. It's appreciated. Now, this is an interesting one. I'll just... So why won't I disclose if I own a house or not? I have actually disclosed. I'll say it again. I own one house. It's the one I live in. Full stop.
A good part of the world, Martin.
Yeah, absolutely. Good part of the world. No mortgage.
Yeah. You'd be happy with the price values you're seeing in your pocket. And, what's driving that price? I know we've spoken about this before, but it's scarcity. You've got limited land where you are in that sort of north part of Wollongong. And you've also got great lifestyle. And so scarcity, lifestyle, great for families, and commutable to the city. Doesn't take a rocket science why your area is doing well.
Well, I can tell you a bit of a story on that Chris. We moved down here nearly a decade ago now, and this area wasn't that well known, and it wasn't seen as that popular at the time, so prices weren't that extended. But over the last few years, they've tended to chase because more people come down, more people realise that there's a train line to Sydney, etc., etc. And it's a great part of the world, and it avoids a lot of the traffic. So, and of course, I run my stuff virtually, so I don't need to go to the city that often. And it's interesting now that in the local area, Austinmere, which is just up the road, had one of the biggest price increases over the last year relative to pretty much all other parts of New South Wales. So it's really fascinating to me how the regional areas are really, on fire at the moment, metaphorically, if not literally. And I guess that the point there is that the data suggests people really want to get out of the city. It's fascinating.
Yeah, and I think that right now it's there's not much going on in the city. I was in there last Friday, right? The vibe's not really there. People haven't returned to offices. They're not really sure about their return to work sort of policies. But I think that, top talent is going to want flexible work. They've experienced it. They've got families, even if it's just a couple of days a week. And so when the talent want that, and the firms want the talent, so they're going to have to change their work policy to offer flexible work. Otherwise, the talent will say, well, I'm going to go to a company that offers me that. And so I think you're going to find that, and that allows the regionals to be a long-term sustainable thing, rather than just a flight there for the people who are really confident that work from home will be around in some form. So, I do think there's a lot more to go to it. I think at some point, though, like I said before, then the benefit of going there was affordability. The affordability's gone. Do I really want the commute as part of my day-to-day if it's not because of affordability? And I think that's where you might lose a bit of steam in these regional areas. Yeah,
that's a good point. I think it will swing back, and I regard as what's happening as a bit of a temporary blip. Interestingly, Smooth Opera said no, debt is the way to go, and my own particular situation is about 20 years ago, I decided to get out of debt, and never have I incurred any debt from that point. Life is so much easier without debt. Recommended.
Depends what you say is easier, Martin. And, you're going to laugh because I'm a mortgage broker, right? But there's a massive opportunity of cost of that decision you made. And I'd love for you to sort of, compare what you could have done with a bit of debt. And if you knew what you were doing and what you purchased, say 20 years ago, when you say life is easier, you still got to earn an income. You still got to provide for retirement. You've still got to pay for things that you want to do. You might want to give away money to your kids, or, just out there in society. And so easy is a thing. Maybe less stress at night because you haven't got to worry about an investment property, but ultimately you might still have to go to work. Ultimately you might have to do things, not saying your situation. So you've got to be very careful taking this anti-debt, philosophy, because saving's tough, and saving money for your future is tough. And so if you don't take access to the way the system is, and negative gearing and debt, it's probably the slow road if you compared to when you know what to do with it. So,
No, I agree with that. I agree. And, the story previous to that was that I was in debt previously, and we bought a property and improved it. And, we used the property cycle to be able to actually create enough money to be able to buy this one without a mortgage. But the point there is that, there's more ways to build wealth than property, right? And the property cycle is not always necessarily going to perform for you. It does sometimes, but not always. But that's true of also other asset classes too. So my strategy has always been to spread a little bit of around into various asset classes. But no, it was a decision we took, both, but my wife and I. And by the way, my wife is much more property pro than I am. So she was quite keen to accumulate a portfolio of properties, and to go into the investment cycle. So she and I had some very interesting discussions about that.
She's the bull, you're the bear.
Exactly right. But, I have to say, maybe it's my background. My father was a bank manager. So far as he was concerned, debt was always, a problem, and should be got rid of as quickly as possible. I've probably inherited some of that. But nevertheless, I sleep well at night.
Yeah, I do think I'm not a fan of, I've got no credit cards. Never used Afterpay or Zip Money. I've got a car lease, but it's kind of written off through work and it makes sense. But other than that, short-term debt, I'm not a fan of. And that's my worry with the responsible lending. I know they're going to try to stop that, but I'm not a fan of, what they do to 18-year-olds and offer them big credit card limits and how people get themselves in problems with that. We've seen huge problems over the last 13 years as an advisor with short-term credit.
Yeah, I agree. Absolutely. Short-term credit, even things like Afterpay and paid loans. Of course, Afterpay. It's interesting. There was a report that came out from the UK just over a week ago. They're recommending now Afterpay and other, buy now, pay later services should be effectively managed as if they were credit facilities rather than the way they're currently managed here in Australia, which is interesting. So that may have an impact down the track. And look, my belief is that there are times when accessing credit makes sense if you've got a particular purpose in mind. But the idea of bringing forward effectively future purchasing power to the current continually and getting to the point where you are just paying Peter, borrowing one to pay the next, Peter and Paul, right? You end up in this debt spiral. And I have seen personally, and I've been involved in advising people with regards to massive debt problems that they've built up, not just over a few weeks or months, but years.
Yeah. And this is all incomes. It's not all demographics. It's, professionals, people on very low incomes, etc. It's everywhere. And and I'm not a fan of there's lots of people who have never, ever lived positively per month where everything that comes out goes out straight away and they're always chasing their tail, and what they've got left goes really fast because they know they haven't got much and it's always going to be gone anyway. And so it creates all these long instability and fear and stress and suicide, and there's all these issues that finances create when it's not under control. And none of the banks will ever take responsibility for that. No, the government doesn't care. I mean, they want all that short-term spending on TVs and clothes and restaurants, etc. That's what drives our economy. So you've got to take personal responsibility and personal accountability, for these things, because unfortunately the system won't protect you.
No, I think that's a very good point, Chris. And of course, the level of training and education relating to finance is pretty low. It's true in most Western countries, but it's very true here in Australia. So there are many people who get into, the middle of a credit environment without really understanding it, and then assume that the banks are actually acting for you, and the advice that they're giving is the best advice for you, when it's not necessarily at all. It's in their own interest, and they look at it from a risk perspective in their terms, not your terms. So you need to be able to stand back and look at it more objectively. And then the other point that I make quite often, I'll say it again, is that a lot of people have no idea about cash flow and money in and money out and how to deal with that and how to quantify what that looks like. And I don't see how anybody can make a credit decision without actually understanding cash flow.
Yeah, especially if you are going into a big mortgage. I mean, we don't really see this part of the spectrum, I guess. A lot of clients are coming to us. They've got they've got through those initial saving issues, and they've been able to save a decent amount for their first home and etc. But I have seen a lot of it in the past. But once you're through that and you know how to save, then it's a case of making sure you use that savings that you've got wisely. You don't go and potentially buy spec stocks or things that, you're trying to get rich fast. I guess that's a big issue that we see. Or we'll buy this and then we'll flip that and make this and invest in that. That's just not how it works. It takes years, it takes patience, it takes buying quality assets, etc. So you've got to educate yourself before you jump into anything, and especially property. Property is unregulated. So the reality is there's so many people out there, you flip open magazines and they're all just selling, duplexes and all these new stuff. You've got to walk through a display suite. Real estate agents are going to find an excuse to sell every single property. I always laugh at some of the things they come up with. So just got to be very careful when you're entering property, because no one's there to protect you. It's actually more protection buying a toaster, if that's what you want to buy.
Well, I'll tell you something else. I think people often do more research on that toaster than they do buying their next property.
Yeah, that's right. And I think the reality is toaster could be dead in 10 minutes, and a financial decision with a property has massive compounding effects. And I don't like to do it, when clients have made a bad decision with property, because hindsight is easy for everyone and it's never judging. And I always understand their situation, understand what they've dealt with and why they've potentially been sold the dream. But when you do the numbers on what they could have bought with that money, and the opportunity cost and what that means for their next decision and their next decision, it's not just 100,000, it's potentially millions over the next 20 or 30 years. So it's destroying lives. A lot of the property spruiking space, and their obligation is, well, it's up to them. It's their decision, and I just don't think that's good enough. I think there needs to be more regulation around, explaining all the facts and figures. The numbers are there, right? And so how many percentage of off the plan sell at a loss after 5 years? What number of apartments are coming to the market, etc. But no one wants to do that, do they?
No, because the news isn't always necessarily that good. And it goes back to the responsible lending stuff, right? So basically, the responsible lending legislation would tilt the discussion away from individual circumstances and calibrated, advice, as it were, to effectively, it's all about risk, it's all about financial stability. And what it basically means is that if an individual wants a loan, and they give you a bunch of information as a bank, the bank can take that information, base the assessment off that information, and if the information is incorrect or something else goes wrong, the bank is not at fault at all.
And that's what they're wanting to get out of the responsible lending, shift it from borrower bank responsible, which they're worried about, to borrower responsible. And you can see why they do that. You're talking $2 trillion of home loans out there, right? So and they're trying to grow that quite substantially. I think it's a really interesting thing. I said in 2020 that I thought buyers would be quite picky, and they were late last year. They were saying, well, I'm going to wait. I'm going to wait for the better street. I'm going to maybe move suburbs, get something a bit bigger. And we saw a lot of our pre-approvals just take time to buy. And that's always a good thing. We love that. We hate kind of seeing clients buy their first property. Sometimes it's perfect for them. But for us, a lot of the time we're like, oh, is that really, have you done enough research, if you really thought that's the right property? Because when people are rushing it, generally they're not thinking it through. Don't really got that market knowledge. But just in the last month, especially the last 2 weeks, really, is we're starting to see that behaviour. The fear in buyers is completely shifting. We're trying to temper that, but we're starting to see auction clearance rates. We're starting to see the momentum out there. I went past a few open homes on the weekend, just took a bit of a detour that I knew someone on, and there was this one property. It was in the beaches, and it was on a very, very poor street. This street is narrow, and it's a cut-through street, and cars were whizzing past each other at 60 k's an hour, and that street's always busy. And there was a queue for this thing. It was probably over 50 people there, lined up way before the open was starting, because there's no other property to look at. And that just shows the desperation. People know that's a poor road. The cars are flying past them, but they're still lining up to potentially buy it. And that's when you know the market's hot. So I thought buyers would be picky, but from what I can see this year, even the poor properties are going to get bought. And that's pretty dangerous, because they're the ones that you're not going to get the longer term returns as you do on the good streets, especially if you have to sell it at a tougher time in the 2020s or to 2030s, etc. So just be very careful. You are in the market now. Don't just get the FOMO and rush or buy a poor asset just so you can get in.
Yeah, well, I often say, Chris, there's always more property. There is.
It doesn't feel like that as a buyer, though. So, I'd say that's a client. Don't worry, there's another one coming. And at that point in time, when they've missed out and someone's offered a stupid amount of money, they're in pain. They feel like they're the silly one because someone else has bought the property and they've got the keys and they haven't. We had a client miss out on a property last week, and it defies logic. It probably should have sold for probably close to 2.5. And a lot of this is, that's crazy, but, this is a great property in a pretty decent suburb. Our client went close to that. And then we found out an eastern suburbs buyer was buying it at 2.7. And we're just like, all right, if you want to pay 15% overs, that's fine. End up selling for 2.84. So, there must have been some extra competition behind the scenes and so you're talking probably 15% over already inflated price from what it probably should at. And so that's some of the stories that we're starting to see.
Yeah, well, I was going to ask you about this question of overquoting, underquoting, and price discovery, because I've had some really interesting feedback from people who've been to some auctions, and in some cases they're still seeing property landing very well under what the expected price was, but in other cases they've gone dramatically over. And so it begs the question, well, is the baseline of the property value right to start with, or is there something else going on? So are effectively some agents, putting the prices too low to try and attract people in and then driving it up, or is the reverse also true? And it's an interesting area, and I'm not sure that it's that well regulated at the moment.
It's not really, because you could base it off of sales in August, because there's very low number of transactions, right? So you could say, I can't find comparables in the last 3 months. I'm going to extend that to 6 months. And, you know, that potentially is, you know, a bit of a market growth there. Plus you've got the Christmas, more people buying, getting pre-approved. It's an enormous amount of, you know, people going to get pre-approved. All the lending numbers are out there. It's not something that we're just seeing as a business. It's out there in the industry. Or AFG, Connective, the ABS stats, etc., showing that lending grows dramatically in the owner-occupier market. So, yeah, I guess it's kind of forgot my point there, Martin. That's a first.
Over and under quoting and
yeah. Sorry for listeners. It is nearly 9 o'clock, and I usually asleep with a 1-year-old by now. But 100%, if you're an agent, let's say you want to be the honest agent, and I always laugh at this sort of analogy. And you've got two dishonest agents who want to sell the property, who want the listings. They've got a business that's all about sort of getting market share, so they want your listing, even if they're busy. Right, so 3 agents come to your house. One B's honest with you and say, look, you can only get 1.5 for this. I'll be lucky to get 1.6. The next person walks in and says, oh, this is a great property. I love it. This is going to sell like hotcakes. You know, you'll get 1.75. And the next agent comes in and says you'll get 1.9. And so who do you go with? Do you go with Mr. Honest who said 1.5, 1.6? He was probably right. Or you go with 1.9. You go with 1.9. And it's the same thing when you're selling and underquoting. Like if that dishonest agents, they will underlist that at 1.3. Because if they don't do that and they listed at 1.5, then they're just shooting themselves in the foot. And so what you end up doing is you get overquoting to people selling, because human nature is you take the person who values your property because you overvalue it. That's just a human bias. And then also all the agents underquote because everyone underquotes. And so you don't want to be the one that shoots yourself in the foot by underquoting, because everyone expects every property is underquoted. So you put it on at 1.5, people are thinking you want 1.7. When you actually want 1.5, well, you just lost all the buyers. So, yeah, it's a massive problem in the industry, and it takes really strong regulation, but it's a hard thing to regulate because every sale, they could argue a little bit different. Oh, I didn't know that the north facing would have valued that much to the value. I didn't know that beautiful frontage would have meant the property went so hot. And it's always tempting for the agent to underquote because it just gets more buyers interested.
And particularly when volumes are low, right? So it's very hard to get analogous price information. I mean, I look at the Value General data all the time. You know, it's one of my key sources of information because it is definitive. That's what it's sold for. But in some areas, there are very few similar properties, that sold recently. So it is quite hard sometimes to try and formulate what fair value is. And then, of course, the other point is that every property is slightly different, right? Because it might be a different place in the street or different direction, etc., etc. But actually, folks, the Value General data in New South Wales and certainly Victoria is accessible, is available, and it's a very good source of truth.
Yeah, I love it. I mean, I love it from the off markets. I've been looking at it in my area, and I was like, I didn't know that property sold. It was never on the portals, and it's a pretty fair price. And I was speaking to a real estate friend this week, actually, and I said, oh, did you know that sold? He's like, yeah, I know the buyer on that. And he actually knocked on the door. He's from so-and-so. And I was just like, wow. So it's actually really good to find out what's also selling off the portals in your suburb, because, you might not even know that they're selling sometimes.
And quite often the data on the portals is completely different in terms of estimated value relative to what it was sold at, right? So I'm amazed at how different those two things can be. So yeah. Now here's one which I just wanted to get into. Donna asked this: why aren't houses seen as a consumable? Why are they even seen as an asset? So we're talking here about financialization and the fact that property is really seen as a wealth generating tool rather than somewhere to live. Now, whether you regard that as a good thing or a bad thing, that is the truth of where we currently are. Hard to see how you put financialization back in its box. I
mean, it's an asset because when you can sell it, there is a benefit as well. There is a lifestyle benefit there, which I think was Donna was referring to there. But it's an asset as long as you can sell it for a greater price than what you purchased, right? And so if you sell it for less than that, then it's probably a liability. So I don't know. It's a hard thing. You can sit on that fence and go, why is this even the case? Shelter, and especially we've got a whole banking system is a huge part of our economy. That's through borrowing money. We feel richer if our asset base increases. We don't own businesses. And so if our home's going up in value, we'll spend more. And if we've got mortgages, then we have to work. And there's lots of sort of thought processes you can go through why the system is what it is, but unfortunately the system is what it is, so you can't
Exactly.
really fight it.
So, and it's interesting because basically you have to play the game that's currently framed unless you change the game, right? And it's hard for an individual to change the game. I mean, to an extent, you can do it by not cross leveraging, as we discussed earlier on. But then there are some upsides and downsides for doing that. But I do think that people sort of get sucked into the property maelstrom here with mortgages and multiple properties and just assume that that's the only way to be. It is worth just pausing and asking why, and is it really the best way to go, right? Because I always believe that taking that extra time to just think a bit harder is really worthwhile. I do recommend that people just pause, right, rather than just getting sucked into it, because it's fascinating talking to people, as I do quite often, and they've just never questioned this whole property escalator thing. They just assume that that's the only way to go.
I think you'll find that we saw this week that some of the banks, and these numbers might blow people's mind, but over 3 to 5 million, you might think that you used to need a 30% deposit, but now you need a 20% deposit. So that's a big change, right? And so a lot of the people who've got that $1 to sort of $3 million property are wanting to upgrade into that range. Ultimately, as people do better, right, and they have more money, there's only so many things you can spend money on, dinners, etc. And housing is usually where a lot of wealth goes, right? You look at all the on the rich list, etc. You look at their property portfolios, or you look at etc. So we want to buy lifestyle. We're only on the world for one life, etc. And so you see a lot of money flows back into property. You do really well in a business. What do? You go and buy a nice house, etc. So unfortunately, that's sort of the system as well. Is that people want to buy property for lifestyle, and so that's why you've got to buy a property that ultimately is providing an aspirational lifestyle. Because if it isn't, then it's just a bog standard property. Never the demand's going to build for it. And if there's only limited number of properties and there's growing wealth and population and etc., and what they all really want is those properties, you can see why they get pushed up in price.
Absolutely. And it's interesting that the question of where you buy and what you buy is very important, right? Because quite often people obviously have a price that they know they can go to. And then the question is, well, so do you buy, in the worst street, the best property on the worst street, or the worst property in the best street, or something in between, right? I mean, there's some really complicated trade-offs that people have to make, because you can never buy perfection. You've always got to be making trade-offs. So how do you guide people, Chris, through those sort of trade-off decisions?
Oh, that's a good question. You're right, because if you think about, let's say the best 20% of properties in the market versus the worst 20% of properties in the market, which ones turn over more? And you have to think about it. Well, it's pretty obvious, right? The worst 20% of properties, people move in, they don't like it, they sell it. It's dark, it's got no, it's got weird floor plans, it's noisy, etc. Right? And versus the top 20% of properties, if you're in that area, you've got a community, you've got kids going to school, where are you going to upgrade in that suburb? There's no other better properties, right? And so they turn over a lot less. So it actually is difficult to buy the perfection in the market. And if you do come on the market, there's lots of people in that suburb that have got other properties, or people wanting to move to those suburbs that see that property and it goes super hot. And so even then you can't get it at a fair price. So there's always usually compromises. There's certain deal breakers for me that I think you've got to be really careful. The road, the noise, south facing, privacy issues. And so some for me, I just think it's not worth the risk. And especially if it's a certain type of asset, are just ruled out, like high rise, high density apartments and new townhouses where they're building lots of townhouses. Just, certain assets you just don't want to buy, they're deal breakers. But if you're buying, say, a house, sometimes you've got to make compromises. And so it's just really making sure that you're not making massive compromises. And if there are compromises that you can change. If it's privacy, can you put a tree up, for example? If it's on a really busy road, you've got to be really careful when you sell that property, because if it's in a market when it's not hot, that busy road will definitely get discounted quite significantly to the better street. If the market is super hot, that gap, shortens, and some of the poorer properties sometimes sell close to what the better properties are selling for. And so even if you buy a good location, but it's one of the poorer properties in that location, you lose the control of when you sell. And you've got to be conscious of that, because you may decide, look, you really want to leave the area, and then you're at the mercy of how good the market is when you want to sell. But if you've got a great asset, you can pretty much sell it at any time. There'll always be strong demand and very low supply. So you just got to be careful. You've got to know what those compromises are. And so it's going through due diligence. And I will always, clients will send me properties, and I always look at the risk. What are buyers not going to like about this property? What are they? And a lot of buyers haven't really thought that through because they're falling in love with the nice things. And I always say, well, why don't you check this? One was last week, check Mozzie's because it's backing onto a lake. And, check the neighbor. Privacy is huge. Check what they're doing up the street, cars, noise, flight path, etc. So you've just got to know what compromises you make and make sure that they're factored into your decision and you're not just going gung-ho on a property that's compromised.
That's right. And I think one of the other things you've touched on there, Chris, which is duration, right? How long do you expect to be in the property, right? Because it's something that quite often people are sort of not thinking through. What I mean by that is if you think about the cost of transacting, right?
Yeah.
Stamp duty and those sorts of things, right? If you actually are thinking of moving on again in a year or two, it almost always doesn't make sense.
Yeah, we're always focusing on trying to buy an asset they can grow into long term. And so a lot of people don't want to make those calls. I want to just do this for the next 5 years. And they just keep saying that for the whole lifetime. And they never make long-term plans because it's always for the next 5 years. You've got to start to make some big calls in life. Where do you want to work? Where do you want to live? What do you want to do with family? How are those things going to progress? Yes, life's unpredictable and things may not go to plan, but at least you've taken action towards that if that's got a higher likelihood. So some clients really have extremely hazy futures, work opportunities all over the world and family is spread out, etc. And so they're sometimes really hard to advise because where they could come back to me in 2 years' time and say, I'm going to move to Brisbane or I'm going to move overseas, etc. And so what we're trying to say, well, what happens if you go overseas? You're going to come back to Australia. Where are you going to live then? You're going to be in Sydney or you're going to be in Melbourne. And so we're always trying to get a longer term lifestyle that they can grow into and not buy into this stepping stone strategy. We'll buy this, we'll flip that and buy that. Because you're right, the transaction costs, but ultimately it's the property that they want generally is a good property. It's a family suitable asset, generally in a good location for lifestyle. And I'd argue a lot of the time that property will grow more than what they go and do with our other investing. And then you minus off transaction costs. So it's always usually a better investment decision to buy it as well. And try to aim for that. Even if it's an unrenovated house in the suburb that you may want to live in, then you give you the scope to do the reno in 10 years time or 5 years time. I'd much rather buy that than buy an apartment that might suit me for a year. Then my situation changes. I meet someone and have a kid and I'm like, oh no, all my money's in that apartment, sell the apartment. And that's been a whole waste of time. So we're regularly sort of talking clients through that scenario.
Right. And the point there about life happens, right? So think about what I call the counterfactual. What if, right? What if my job disappears, or what if there's a relationship change? All of those things has to be part of the thinking process, I think. And so quite often it's not, though, when I actually come across people who, because I chat with people on a one-on-one basis quite often, and it's quite interesting how limited their aperture is in terms of the counterfactuals they deal with.
When it's kind of drilled into me, business owner, life, buffers are everything. So if you're a property investor, what matters is your buffer. And so you've got to build that. If you're buying a house, what matters is your buffer, right? Your sleep at night factor. So what you really want to do is maximize your buffer at all times, even if you don't think you need it. Because when you do need it, you'll go to a bank and a bank will say, hang on a second, you just lost your job. I'm not going to lend you any money. And so you always want to be maximizing buffers and the biggest buffer you can make is buying a quality asset. Taking a big $1 million risk on a poor asset and then having no buffers, you're like just stitching up yourself, right? So having buffers and buying quality assets. Good thing right now as well is, let's say it's you're worried about future rises in mortgage repayments or losing your job. That's when you might want to potentially look at fixing, right? So you have a good buffer for say 3 or 4 years, and you fix on a very low rate. It's just why that, because there's just so much under the variable. And then something happens. Well, I've got 4 years of repayments there as a buffer because rates are so low. So you've always got to be thinking buffers and quality assets.
Absolutely. And, the concept of having that buffer and not running right up to zero cash flow. One of the reasons that I'm concerned at the moment is we've, got very high mortgage stress, right? And I use a cash flow measure for our surveys on mortgage stress. And what that basically means is there are a lot of people who have no buffers, right? So everything has to fall exactly right for them to be able to actually stay afloat. And if things start to go adverse, so rates go up slightly or the job hours reduce, that then starts to grind them down. And that doesn't make them fall over on day one, but it just lays the foundation for a bigger fall later. And that's what I'm concerned about. So I always say cash flow, cash flow, cash flow. Think about those buffers. Make sure that you've thought through well, what if this happens, right? Because sometimes the right answer is don't quite borrow as much. Buy something just a little bit more within your means. And I do like your point about fixed. I mean, fixed rates at the moment are remarkably low. So you'd almost think that, just locking that in, it's worth it for the insurance that, rates can't go up from this point. So it's quite useful.
I think those mortgage stress that you do, Martin, and, while you've definitely got the data to back it up and show where the stress is, it doesn't take, you just got to think it through. Where are those issues going to be more prevalent in the city and what demographics are likely to have those issues? And so where you're likely to see those people got very high loan to value ratios. That means they've used every single money that they've got to buy the property. And so who would do that? Well, a lot of it's first home buyers. And what first home buyers generally do is they buy in areas where lots of other first home buyers are buying, house and land packages in the fringes. And once they've put everything in for the deposit, they're also at the family formation stage, a lot of them. So they're going down to one income. And things are tough. You've got to pay the mortgage. You've got to pay all these sort of things. You might lose one job. And so that's where you're going to see those problems. Are you going to see those in the inner ring? Potentially for the people who go and buy a $2 million property with a $2.2 million debt. But that is quite rare. It's not what you usually see. Generally, people have got other buffers. They've got other shares. They've got other assets, etc., and they can fall back on. And they've usually got a bit better sort of financial literacy and know how to save and knuckle down, etc. And so you won't generally see those issues as prevalent in those more established. And even still, if you did, 30 or 40% of properties in those areas are paid off. 30, 40% have got low debt because they've been owned for 10 or 15 or 20 years. And then you maybe have, of the other 20 or 30% left, only a portion of those have leverage with not many buffers. And so even if there was a spike in those, you're not going to see lots of stock come on. They'll do everything they can to keep those properties. So mortgage stress is definitely in certain pockets. And then you've also got the investors. The investors are over leveraged and don't know what they're doing, etc. And they can be anywhere, obviously. And so they're definitely another part to it.
Yeah, and you make a very good point about the specifics of mortgage stress. In the high growth corridors, basically, that's where it's worse, and that is where a lot of the new stuff is being built.
Yeah.
And that takes us very nicely into a question here, which basically says, can Chris discuss the pros and cons of buying in a new house and land estate? Are there pros? I mean, I can see some cons, but
So you've got to really think philosophically about this and deeply around it, and it's not that deep, to be honest. So what you're buying land and you're buying a house. So is that land scarce in a house and land package? Now, if it's an infill site in a middle ring suburb, which are very hard to find, potentially it's scarce because it's an infill site. But 99% of them are on the fringes of capital cities or in the middle of nowhere, between two cities. And so is that land scarce? No, you look over the potential back fence and there's another farm and there's another farm, etc. Also, it's probably 350 squares. And, is it that square? Well, there's a lot of land. There's a lot of lands coming. So you're buying something that's not scarce in terms of land. Now, most of your money is probably going into a new house. Now, a new house is like a new car. And so, yes, and a lot of the builders are probably charging a decent whack for them right now because of home builders. So you're not even getting a bargain on it. It's built quality. It's cookie cutter. And it depreciates. The light switch, the oven, the roof, etc. And it's also targeted at the affordability market. And so you've got where incomes are restricted and it's not aspirational for those higher incomes. If the higher incomes people are living in those areas, generally when they start to build more equity and their incomes go up, they leave those areas. It's just the reality. Very few stay. They want to upgrade. And so you get this, lots of low incomes that can't really afford. And the thing is, when you go and sell that property in 5 years' time, what's going to drive it up is scarcity. Now, if there's no scarcity of land, what new buyers will do is, why buy a house 5 years old when I can buy a brand new house, usually for the same price, sometimes cheaper because of kickbacks with government, than buying a 5-year-old house. And so what you do is you get a flatlining of prices. The same thing with apartments in sort of Sydney, Melbourne. So no scarcity of land, and the most of your money is going into the part that's depreciating, which is the house. And so that's just the reality. So what you want to do is buy land that's scarce, and they're not producing any more of it. And it's highly desirable, sort of aspirational families with growing incomes in the area, etc.
And the other point, Chris, there is that people often want to buy new relative to second-hand properties. So if they are building in the next suburb and they're building more new stuff, and you bought a year ago and it's no longer new, it's going to be down in value, isn't it? And I saw in Perth, right, where there's been a lot of homeland packages being built, existing property in and around the same areas have dropped, whereas the prices of those new homeland packages went up by the amount of the government stimulus.
Yep, exactly. And people say it's a lifestyle asset. I want to live there, etc. And there is an argument for that. And you want to live in something that's brand new, but ultimately you've just got to be aware there is an opportunity cost on your future financially. And you are buying an investment here, and you are going to sell it one day. And there is going to be a point in time where if you made a different choice on where you lived and the type of property that you purchased, you'd be in a completely different position, and then you have different options for all those years in the future. So just got to be very careful about buying for today. I want it, etc. It's like buying a brand new car. I want a new car. I don't want to buy a used car because it could break down. Well, you could buy a good used car pretty cheaply, and it would get you A to B, and it's not going to break down. But it's kind of buying for today, not for tomorrow. And and so that's unfortunately the problems in these areas.
So just being slightly philosophical moment, there's a thing called punctiliar action, right, which basically is a type of a verb that defines a point in time, but also defines its impact into the future.
Right? Okay. Yeah.
And I think buying a property is a punctiliar action because it fundamentally defines not just where you are now, but what things will be like in 2, 3, 5, 8, 10, 15 years' time. It has huge downstream consequences.
And it's not just 5 years, like you're 30, you could live to 90, and, you've got a lot of living. And so there's all these sort of compounding things, and you don't want to compound it too much, can be quite painful, but I won't even try to say that word, Martin, at this time of night, but it's a good one. I'm going to write it down.
I'll send it to you afterwards. It's quite a useful one to bring out. And we've just got a few minutes left before we close out, but here's one which I think is really worth taking a part of it. How many young Aussies or first home buyers utilise parental guarantors? And I'll say, or bank of mum and dad.
Smart question for a border collie, I guess, but the border collies are the smartest breed. We are seeing lots of gifts in that. We are very apprehensive on doing parental guarantors. We've done a few recently. We think there's got to be so many hurdles that of clients have got to jump through for us to feel comfortable that they're doing the right thing for them, but most importantly, the person giving the guarantor. Most parents want to help their kids get ahead, and they know the difficulties for them to buy their first home, etc. The problem is that a lot of the kids take it for granted, I do believe, and a lot of kids don't know what they're doing with the money, right? We get this guarantor and they go and buy a poor asset. So buying a good asset's the first thing. Secondly, what the parents are going to do in the next, say, 5 years. Are they going to sell? Have you got brothers and sisters, arguments at Christmas, you got it, I didn't get it, etc. What happens to the relationship? That's the risk with parental guarantors. We all know that relationships don't all last, and especially, younger ones can potentially in those first few years, they go and buy a house and they break up 2 years later. They do that and they buy a poor asset, then the parents foot the bill because one wants to get off the mortgage and they have to sell. So are they common? I reckon they are. We probably say no to more than we say yes to. But I do think they're going to be something that, especially in this sort of market, the parents will be like pushing their kids, just buy something. And that's usually not a good thing, because the parents have bought probably 3 properties in their life and they read the news, which is all hyped up, and they're just forcing their kids to buy something without any market knowledge or what worked for them in the 1980s, etc. So that's the sort of story of parental guarantors. They are quite common, but we see gifts much more common.
Yeah, and I'll add to that the bank of mum and dad was very active, became less active, but it's becoming a bit more active now, where effectively people are handing money across down the generations. Of course, that is predicated on the assumption that the parents have sufficient equity and other assets to be able to see them out into their retirement. It is a bit of risky situation sometimes to do that, and yet people do it quite a lot.
Yeah. I mean,
Okay.
superannuation, we're seeing how the returns of that have been. If your super balance has gone up, the agents told you your house has gone up, you start to feel more wealthy, and then you start giving more money away, right? So, 2018, super's dropped, house prices have dropped, or, even April last year, I'm sure the banker mum and dad didn't want to give anything to the kids because they're worried about their future. So, absolutely, rising house prices and asset prices, encourages them to lend more money.
Yeah, absolutely, and it's a bit of a sort of a cyclical thing. Also, the banks, of course, ask quite a lot more questions about where did that money come from, right? Now, that's because of responsible lending, because they have to ask those questions. If responsible lending goes, they won't care two hoots where the deposit came from.
Yeah, and we could see, a lot of people start to take out personal loans, who can, do a personal loan plus service a mortgage. We start to see some more lenders sort of come into that space. So it's a very risky strategy, right? Not only have you not got the deposit, but then you're borrowing a short-term money to cover a deposit so you can buy a property, etc. But that's something you could see with responsible lending going, is those type of things pop up.
Yeah. Plus, of course, pulling out superannuation, which is also been a bit of vogue at the moment. So people have got, 10,000 plus 10,000 to add in.
Yep, and who's to say that there isn't a policy that pops up? The government are very good at coming out with these policies. You and Martin, I've sent you text messages before and gone, WTF or something like that. What are they doing? I mean, I'm not a fan of people allowing to access their super to purchase a property. I understand that, that's definitely what a lot of first home buyers want to do. Unfortunately, though, as we've spoken about lots on this, is you'll increase a lot of credit growth because you'll increase a lot of demand in a short space of time. You'll do one thing to asset prices. So it's like a little bit like change to stamp duty. A lot of first home buyers just need to do the yards, save money, and not just think that super is the ticket out. Keep super for retirement, and do the hard yards. And
Tim Wilson, please note. Here's one which is actually quite an interesting one. Impact of migration, reduced migration, and potentially that was obviously a big driver. Interestingly, I do see a few migrants coming back home with quite big balances to be able to buy property. That's happening still at the moment. I'm also seeing some interest from the US and from the UK of people wanting to migrate here long term because of what's going on over there. But what's your sense in terms of the migration story at the moment?
Absolutely. I said this 6 months ago or something like this on this channel, and I said that the short-term migration, yes. Long-term, I'm not concerned about at all, especially Australia compared to the world and etc. Especially how we've handled the last year, right? So long-term, there's still going to be a lot of people wanting to move here, but that's not going to change. The short-term, absolutely. There's no more people moving, but where's that affecting? Where would they have moved to, and what would they have purchased if they did move here? So all the apartments are definitely getting smashed with no short-term migration, right? Because that's a lot of them are uni students, a lot of them are, the 457s, young couples, a lot of people, etc. So, that is having an impact on that market. Is it going to affect demand in a few years' time? Yeah, because a lot of people who moved here in 2020 and 21 and 22 would have purchased a house, and so it's future demand. But you don't just move to a country and buy a property the next day. There's potential issues with permanent residency, etc., and visas, etc. So there is a longer term lag. Unfortunately, though, it also generally does hit certain parts of the market, and we do find it is a lot of that sort of newer property, etc. It's not like they move here and then they go and buy a house in an absolute premium suburb straight away. So I'm not too concerned about that on quality assets. Potentially a little bit reduction in demand, but I think longer term that'll be offset because the ticket to the game is once there's people can move around. I know I'm saying that's going to happen, but hopefully it does. I'm on that camp. Then I do think you'll find that the government does sort of relax and plays catch up in their book and starts to open the borders.
Yep. Well, I run different scenarios as I went on through my show last week. Depends on when the borders open and all those things. The Treasury is still suggesting negative net migration this year and next year, which is quite interesting, right?
I forgot to
And
say there, Martin, sorry, around people moving back to Australia. Absolutely. We've had clients all over the world, looking to buy back here. Even today, we've got one from Hong Kong, who, is doing really well in finance over there. He's going to go and buy an amazing house back in Adelaide. Another guy in Singapore bought an amazing house in Melbourne, right? So they're trying to buy that house they move back to at some point. They do need a 30% deposit. The rules around that are much tighter than they were. It's interesting to see how they change over this year as well. But a lot of them do need 30% deposit to borrow anything that's significant. Some banks like CBA will do more than that, but the way that they do their servicing is really, really tough, to be honest, and how much you can borrow. It's nowhere near what they could borrow if they were earning that money in Australia, a third of that, let's say. So the foreign sort of borrowing isn't right because the banks have got tight lending on it. But if they relax, absolutely, you'll see a lot of people living all over the world that'll want to buy investment properties in Australia, especially if they're Aussie citizens and things like that.
Absolutely. Well, Australia is regarded as a very attractive place for all sorts of reasons at the moment, not least because of the COVID situation.
Yeah.
Got one last question to touch on, and that is underwriting standards, processing times amongst the banks.
Oh, yeah.
How quickly a mortgage is getting approved or not. That whole area, that's something which is just worth, I think, highlighting.
So all the banks have had huge credit growth. They also cut back staff with COVID, etc. They've got a lot of offshoring that hasn't worked out for them, and teams shut down, etc. And so they've also got movement of credit assessors to certain banks that are growing faster than others. So some banks, you can still turn it around really strong. We do a lot of work with Macquarie, and turnaround times are fine. Credit assessors are very consistent, etc. But some banks, for example, have got massive problems with training of credit assessors. We're actually training the credit assessors for them and explaining what offset accounts are and how to structure loans. And it defies logic sometimes. We have to explain policy to credit assessors. So that's a big problem at the banks because they've had huge influx of applications and they haven't got the trained staff to deal with it. Are we getting declined loans? No. Some banks, through algorithms, are looking at credit files in a lot more detail, and they're putting that as a bigger weighting. So, but some banks will always want those as customers. So we're not really seeing that forensically looking at living expenses. But we, I guess, as a business, don't really play in that space as well. So I am a bit biased to my little world and the type of clients that we work with. We don't very generally see those clients or do lots of those applications that would get declined. And so I can't really talk really out there as a macro view. But yeah, turnaround times are horrendous. It's not just the initial to pick up the file. There's always a bit of a tennis match with you and a credit assessor, especially if they don't know what they're doing. And they'll ask questions and then you give them answers back. And then they'll ask some more questions. They've probably already got the paperwork there for them. And then every time you go back and forth, it goes back into a queue. And then they'll ask for something else. And then they'll lodge it to the higher level. And higher level will say, you didn't clarify this, etc. And so, unfortunately, turnaround times are blown out because constantly you're going back to the start of the queue, etc. If you are looking to get a loan, definitely just start the process early. Give yourself that time. Know that if it doesn't, not the end of the world if you don't use that bank, especially if it's a pre-approval, because you might buy 3 months later. A good broker, because it's a purchase, you're in a different queue than pre-approvals. Pre-approvals, the bank know that highly likely you might buy, and if you do buy, you might go to a different bank. So they're not going to put you ahead of someone who's got a contract of sale and is settling in 6 weeks. The same as a refinance. A refinance, you've done all the paperwork. You're not going to go lodge an application and do a refinance elsewhere. So you two are great customers to the bank. Pre-approvals always get pushed down the queue. So that's kind of the reality with banks at the moment. If you need speed, unfortunately, you probably should have, got action a few weeks ago and got the process sorted. And that's kind of the reality.
And it's just worth highlighting that the statistics, of course, have not drawn down loans, but effectively approved loans, right? Or ones in the queue, as it were. So sometimes the ABS statistics may overstate the actual written loans because it takes a bit of time for that process to run through and the written loans to get written, right? So it's quite interesting comparing the two. A lot of people don't understand the difference between those two measuring points.
Yeah, definitely. If it's a pre-approval, then a lot of those don't go ahead, and that's just the reality. They go and get burnt in the market. They change their plan. They and they just don't buy. They just go on with other things in their life, etc. So, or they go with a different bank. So they've got 2 applications pre-approved, and so a lot of those things, if those are in the numbers, I'm not sure, Martin, if they are, but if they are, then it's 100% overstating it.
Yeah. Well, you can look at it. There are 2 different ways of looking at it, and the ABS statistics aren't very clear unless you really look closely. And of course, it's always the bigger number that people settle down on. Well, Chris, we've pretty much come to the end of our show tonight. Any last thoughts from you in terms of what people should be thinking about now with regard to the market?
Probably go to bed. And when you're thinking about the market, try not to buy into the one market. And I say that every time. It's trying to think about your life, your role within the system, what you want to achieve, your family, etc., and then making the best decision based on your situation. And then once you've bought a quality asset, you can switch off from the news. You can keep watching Martin's show, but ultimately, you've got to just focus on your situation and less about the hype and what the market's doing. Because what you want, if you try to play the other side and say, well, ultimately, I think the market's going to fall, or something's going to happen in China and there's a trade war and etc., and you start making all these bets on your financial future and you get it wrong, what's the impact on yourself lifestyle wise? And so you've got to be very careful what side of the fence you sit on with this sort of discussion. Yeah, thanks, Chris. Well, I just say thanks to Jay there for the $50. It's really appreciated too. And well, we've come to the end of We'll split that, Martin.
Pardon?
We'll split that if you like.
Sure. Yes. No problems. Absolutely. So thank you very much, Chris, for your time tonight. That really has been terrific, and a lot of positive comments there in the chat already in terms of your advice. And what I like about you is you call it straight, you tell it as it is, and I think there's always lessons to be learned. So thank you very much for that. Yeah, and I look forward to chatting to you in a couple of months' time. I mean, we were doing this quite, regularly every 2 months, and 2 months is a long time in a hot market. And so we'll start at Feb. I'm a little bit nervous how the conversation's going to go in April, so I look forward to that chat, Martin. Yeah, well, we'll do it again. Absolutely, love to have you back on, Chris. And so thanks very much. Have a good evening. You too. And have a good sleep. We'll sleep well. See you again. Cheers. Bye. Okay, bye. So there you go. Great advice from Chris there, and very, very important messages there. So just to highlight a couple of things before I go. Firstly, if you're interested in a one-on-one conversation with me about a particular postcode, I'm still doing that at the moment. A lot of people are, and there is a fee involved and a bit of research, but people are trying to understand in detail what is going on. So that service is still available. Send me a message if you're interested in engaging around that. The other point to make there is that next week I have Damien Klassen on, and Damien will be talking with me about the market exposures in uncertain times. We'll be talking a little bit about a certain games stock from the US and a few other things too, and what's happening in the market. So join me next week for that show, which should be at the normal time at 8 p.m. And with that out of the way, I think we're pretty much done. So thank you all very much for your attendance tonight, your comments, your ideas and thoughts. Always appreciated. Always enjoy all the side chat too, even if I can't necessarily respond. And we will see you same time next week. This is Martin North from Digital Finance Analytics, signing off.